Hello friends, welcome to the video in which I will discuss with you the concept of hedging and diversification as well as key differences between these two concepts. Those who have studied finance would have come across these two terms multiple times, so it makes absolute sense to understand differences which exist between these two terms. Diversification for most of us, or rather for all of us, simply means not putting all your eggs in one basket. This is true in context of investments when you decide to spread your investment across asset classes and do not focus on just one asset class. So if you have 100 rupees to invest, you will invest it in shares, bonds, uh, gold, and many other asset classes. That's what is diversification. Hedging, on the other hand, is focused on reducing the risk, not by just diversifying, but by focusing on what amount of risk or what value of risk you want to mitigate. So hedging is very specific in terms of ensuring that all types of risk that you face gets mitigated. So let us see the differences between the two with the help of this particular grid. What is the objective of hedging? To reduce or eliminate specific financial risks that you have. Either you reduce it or you eliminate it. Both are possible. When you reduce it, what it means is that you have a risk appetite and you are ready to take some risk. When you eliminate it, your risk appetite is kind of zero and you don't want to take any risk, right? Diversification is all about spreading risk across various investments, which I have already explained to you, right? So you are not putting investments in one instrument, you are rather spreading it across instruments. What is the approach? Involves taking an opposite position in a related asset, which means if you have bought an asset to hedge, using some instrument, you will take an opposite position. For example, you may have bought shares in the spot market and you will sell that in futures market to hedge. That is what will create hedge. So hedging is like taking opposite position to nullify any effect of change in the values or change in the price or change in the risk that will arise because of that. Diversification involves investing in mix of unrelated or less correlated assets, right? So the assets in which you invest, okay, have to be less correlated, because if assets are perfectly correlated, then you don't get any benefit of diversification. Correlation means how two assets move in response to each other. Instruments used could be derivatives predominantly when it comes to hedging, like futures, options, forwards, and swaps. While in case of diversification, you will use different asset classes, which I have already told you, like stocks, bonds, mutual funds, real estate, etc. What are the types of risk that we address with the help of hedging? We address both types of risk, systematic and unsystematic. So it basically takes care of holistically all types of risk that you may be facing. While in case of diversification, we can only reduce unsystematic risk. So systematic risk stays. There is no benefit of diversification uh, which will reduce systematic risk. And systematic risks are, risks which are uh, you know, uh, there in an economy because of multiple factors such as inflation, interest rate, tax changes, and all that, right? Unsystematic risks are very unique to a company, right, or to a business. So systematic risks are more generic and unsystematic risks are very specific to a business. For example, strike in a factory of a tire company is an unsystematic risk because the risk is faced by that particular company only, right? It is not faced by other companies. While risks such as GDP, inflation, interest rate, all these are common to all the companies, almost common to. What is the cost when you hedge? Hedging involves a cost, maybe premium for options or margin for futures that you will pay. Okay. Diversification may not have explicit cost but could limit upside potential. So when you diversify, your potential gain obviously goes down. Plus, you don't pay any specific cost. Maybe some transaction charges you will pay if you are diversifying assets across different kinds of investments. What is the time horizon? Hedging can be done for short to medium term, and diversification is done typically with a long-term objective. What is the effectiveness? Hedging is more precise, targeted risk management. So you know how much risk you want to manage, and it's very, very focused. Uh, Diversification is broader but less precise risk mitigation, right? Uh, it is like, you are trying to reduce the risk. Your diversification may not always be perfect, right? But it's a broader estimate of how you can reduce the risk. What are the examples? For example, you can use currency futures to protect your exposure in USD INR transactions, and diversification will be broadly with investing in different sectors like IT, pharma, and banking. So these are the differences that you will have when you look at hedging and diversification. I hope this video has helped you get this understanding. But if you have any doubts, you can write to healthofmywealth@gmail.com. Thank you for watching this video. Please do like this video and subscribe to my channel. Thank you.